Bern, August 14, 2026. Switzerland has published a new national risk assessment on money laundering and legal entities. On August 12th, the Federal Council was briefed on the findings. The message was clear. Foreign legal entities and complex legal structures pose a higher money laundering risk. The report is not saying that companies are dangerous. It asks a more precise question. When does a legal structure become a tool for concealment? To answer that question, the NRA combines MROS suspicious reports with police cases, prosecution findings, supervisory evidence, public registers, and assessments from the private sector. Between January 2020 and June 2025, MROS received about 53,600 suspicious reports. The analyzed data contain more than 20,000 legal entities and arrangements. The decisive factor is not the legal form. It is whether the entity has genuine activity, a credible economic purpose, and a clear chain of control. The NRA measures 5 risk factors: the amount of assets, structural complexity, country risk, the involvement of domiciliary companies, and the presence of politically exposed persons. The risk index shows a clear gap. Swiss legal entities score 1.6 out of 5. Foreign legal entities and arrangements score 2.5. This does not make every foreign entity suspicious. The higher score reflects a combination: more domiciliary companies, larger assets, greater PEP exposure, and increased country risk. The first distinction is the domiciliary company, a legal entity with no genuine commercial activity, created mainly to hold, manage, or transfer assets. A dormant corporate shell is different. Its business has ended, its economic substance has disappeared, but the legal entity remains registered and can be reused. A front company may be genuinely operational. The danger is that legitimate business activity can conceal criminal proceeds and mix illegal money with lawful revenue. The NRA gives a revealing example. Victims were tricked into disclosing their banking details. The stolen money was then sent to 3 Swiss construction companies. The money did not behave like construction revenue. It was rapidly withdrawn in cash or transferred onward, giving the accounts a strong pass-through character. MRS referred the case to the cantonal authorities, which opened money laundering investigations. The lesson is simple. The corporate documents described construction, but the transactions told a different story. The next risk area is the trust. Legal ownership sits with the trustee, while the economic benefit belongs to the beneficiaries. That separation can make control harder to see. Trusts score 2.4 out of 5, close to foreign legal entities. The greatest concern is the discretionary trust, where beneficiaries may remain undisclosed or change over time. Another layer of opacity is the nominee. The nominee appears as shareholder or director, but acts on another person's instructions. The registered name may not reveal who truly controls the company. The next risk is not the profession itself, but the service. Legal, notarial, and fiduciary work can be misused to create, manage, or transfer structures that conceal criminal assets. The address itself can be a warning sign. Around 4 in 10 presumed domiciliary companies share a CO address with at least one other such company. Between January 2020 and June 2025, MROS received only 57 reports from lawyers, notaries, and fiduciaries involving legal entities or arrangements, less than 1% of all reports. The report describes a Geneva foundation that appeared charitable and environmentally responsible. In reality, its bank account received money from victims of a fraudulent cryptocurrency investment scheme. The incoming payments were presented to the bank as charitable donations. Once received, the funds moved onward to shell companies in Lithuania, Romania, and the Caribbean. In total, 2.5 million Swiss francs were laundered through the foundation's accounts. Its accountant was convicted of money laundering. The respectable purpose on paper did not match the real financial activity. For commercial companies, terrorist financing risk is generally marginal. The picture changes for associations and foundations, where fundraising, cross-border projects, and the final use of funds require closer scrutiny. But inherent risk is only the starting point. The next question is resilience. How effectively do transparency rules, due diligence, supervision, and enforcement reduce the remaining risk? The first line of defense is due diligence. Identify the beneficial owner, verify who controls the entity, and keep that information up to date. On October 1st, Switzerland's new transparency framework takes effect. A federal register will centralize beneficial ownership information for authorities, financial intermediaries, and covered advisors. The purpose is simple: make hidden ownership harder to conceal, and give the authorities faster access to reliable information. The register is not just a database. A federal control unit will use discrepancy reports and risk-based checks to test whether ownership information is accurate and current. The revised framework also reaches certain high-risk advisory services. Where it applies, advisors must identify the client and beneficial owner, understand the purpose, document the transaction, and organize effective controls. The reforms strengthen the system, but the NRA is clear. Their effectiveness must be tested, especially for advisory services, complex structures, and fiduciary arrangements. For practitioners, 5 questions matter. Is the activity real? Does the structure make economic sense? Who controls it? Why these jurisdictions? And do the transactions match the declared business? The legal form is secondary. Risk rises when ownership is hidden, structures cross jurisdictions without clear purpose, and transactions no longer match the business. The practical message is simple. Do not stop at the incorporation documents. Test the purpose, trace the controller, challenge the structure, and follow the money. Legal entities are essential to the economy. Risk begins when purpose, control, and money no longer align. Look beyond the paperwork. This is REG FLIX.